are back with you live on a Thursday, this July 10th. If you're watching us live, if not, it's July after the 4th of July when we're recording this. Zach Strickland, head of Freight Market Intelligence, Thomas Wasson,
Namaste, trucking analyst.
trucking enterprise fleet specialist, I guess is your.
There's so many titles at this point. I'm just going to say analyst at FreightWaves.
And yeah, I mean, you're a data guy from the trucking environment. Let's just call it that.
Yeah.
So we've got Dr. Z, hopefully coming on later in the show today, but the focus of this episode will be on second half expectations. I think that's kind of the thought right now, is that we've had this roller coaster ride of a first half of 2025. A lot of people feeling a little bit of a crunch, in terms of uncertainty. The economy's not cranking like a lot of people expected it would at this point of the year with the new administration. And we're still going through this back and forth with tariffs. And I think that just has a lot of companies in this almost constant state of unease.
Uncertainty is the word I keep hearing as well.
Yeah, and there's just not a lot of momentum behind any pure decision-making going on. It's a lot of ad hoc. It's like, we're going to wait and see how this plays out. We've got, another round of threatened tariffs on copper that could throw some supply chains into disarray, as much as 50%. I haven't done research on that yet to see what that might actually do for the transportation market, but my initial thoughts are it's not going to be good.
Yeah, not good for the air conditioning too. People stole copper before the potential for tariffs on copper. So hide your kids, hide your wife, hide your HVAC unit. If it does get to 50%, it may be a hotter summer than expected.
Yeah, I'm not as versed in these markets, but knowing that futures spiked on just the thought of it tells me that it's going to be inflationary. And that's the point of these tariffs, is they are inflationary to the thing that they are trying to tariff. And that's because they're trying to negotiate and get some sort of balance, something in return, which has been this president's real, big focus is I want something in return. What that is at this point for some of these countries, not always clear. And I think that's what's creating a lot of this stagnation.
Yeah, the macroeconomic uncertainty has been not only in the truckload space where I'm at. Whenever the economy feels the jitters, the trucking industry definitely gets the shivers. That's my little soundbite for that one today. And so, coming back from a recent investor conference at Daimler, executives at one of the largest by market share North American Class 8 truck automakers were reflecting the same thing. We've got a lot of good information about the potential impact on tariffs with aluminum and steel, which is another thing. It does appear to be not only we have a double whammy with tariff uncertainty related to countries' manufacturing in the global supply chain, but the raw materials one is another underreported threat, because it's one thing to be NAFTA 2.0 compliant on your Class 8. It's another thing that the very steel you buy has now just gotten more expensive. So a lot of uncertainty, and it is making things very difficult for decision makers across the board to figure out what's next.
Yeah, let's go ahead and dive into the freight market into situation here, Thomas, if you want to count me in, and we'll get everybody let's level set with some data. I always like data. All right, so let's start things off with the IOTI, which is the Import Ocean TEUs Index. This has been a very erratic index this year if you're looking in the white lines there, as it's gone up and down, up and down. Now, the first up and down, Chinese New Year, Lunar New Year, is part of the process. That's always there. The rest of it, however, not necessarily so much. We've got some undulation and then a big bottoming out in May, and now we are back above 2022. This is a big thing because this is measuring the amount of containers that are bound for the United States. Now, it's not the same mix that we had before. A lot of this freight's now coming from Vietnam, Thailand. I think even Italy and Germany have gotten a little bit of a boost.
India's up there as well. Vietnam is bigger than India. The funny part is Vietnam is much larger than India in terms of amount of share, but we do see from that Southeast Asian belt as well.
Yeah, and that's really been kind of another target of recent rounds of tariffs, as Vietnam is now looking at a 20% tariff versus the 10 that they had because, Donald Trump is trying to remove the fact that they're scrubbing the freight from China, as it were to say. So volumes are up there for the imports, but that doesn't necessarily mean that everything is moving inland and quickly. So let's look at the OTVI and the next chart here. Tender volumes down consistently year over year at this point with, we're kind of bottoming out for the July 4th holiday. Truckload volume not exactly robust at this point. This freight is largely getting sucked into intermodal or in warehouses as it lands on the ports. And one reason I know that is because one of our guests that we're about to talk to, the LMI inventory levels, if we go to the next chart, inventory levels are on the rise. Once again, we are back at a 59 as inventory levels grew in June. And we'll talk about this in more context here in a little bit. But let's follow up with the last chart here with the OTRI and look at what rejections are doing. Volumes down, tender rejection rates still outperforming last year, which is the big unexpected move. I mean, who would have thought? If I'd have told you back in the day, listen, the truckload market right now, you're down 14% demand, but your capacity's tighter.
No, upstream. That's one of the fascinating things. The contract space remains in a more favorable position than the spot market. It is a tale of two cities, the haves and the have-nots. These smaller carriers and owner-operators are still flooding. There's too much capacity. We see that reflected in spot rates. The return of seasonality is good. We see that reflected in the data. So that's the good news. But the bad news is like, where do we go from here? Because typically, both in the contract and spot market, we have the summer doldrums before the back to school season and then the traditional peak season. So it is good, but in the words of HBO Chernobyl, not bad, not good, but could be better.
Right. We do have one article that I wanted to call out. Stuart Churls on FreightWaves.com. We've got a bunch of tariff back and forth. I could have talked about the Brazil stuff, but that's a lot of speculation and unknowns there. And I don't like to get into the politics of things. It seems like everything has been politicized quickly. And I try to stay away from that. But here's one that I think we can talk about, and it's tariff pauses unlikely to halt tumbling Trans-Pacific freight rates. And this is an interesting one to me too, because he uses the Freightos rates here. And if we can pull up that chart to show the audience, but I showed you the IOTI.
Yeah.
Volume's up. Guess what's not going up? The rates. The rates are not going up. If you're looking at this chart, you're looking at the spot rate of a 40-foot container going from China to North America's West Coast in white and the North American East Coast in purple, and the spread between the two is in orange. I put the spread on there because the spread goes higher. This is telling you that it's favoring the West Coast shipping channels. Yep. And this makes sense because of the continued Mideast turmoil. So a lot of the carriers will influence their customers to kind of use the lanes that they want them to use. Keeping rates higher going to the East Coast is a way to kind of push freight into that Trans-Pacific lane, which they clearly have enough capacity for as rates are going down.
Yeah. And I mean, that's one of those big upstream indicators. And, from trucking, I feel like a catfish at the bottom of the pond. And when we're looking at Freightos and everything else, just think of it looking up. And maybe we'll see some of these morsels. But that was one of the bigger things, that modal shift. Yep. OTVI you mentioned earlier, volumes are down on year-over-year comps for the past 2 years. But rejection rates are up. It's definitely a weird situation. The big question for me moving to that second half as we're looking at forward-thinking statements, is this a structural trend?
Yeah.
Will this be the new normal?
Yeah, and nobody's expecting the volumes to really expand further on the ocean. So I think it's kind of like they're getting ready for freight demand to kind of fall with all these extra tariffs, I think, is what the point of that article was. So let's bring on the man who has been on summer break for what feels like an eternity now, and he's living his best life, as he clearly is. If we pull Dr. Rogers.
Hey guys,
man, look.
Have you guys not been off work for 6 weeks? Is that just me?
Every time I pull you on in the summer, it's like you're reminding me of why I should have just gone back to school, gotten my PhD, maybe learned something when I went there instead of not paying as much attention as I did. Man, you're living that.
You're a super senior. I mean, it's really a great time.
Man, so I mean, let's get your second half of your summer kicked off here, because you clearly are enjoying yourself. I'm surprised you're not on the beach, by the way, at this point. Just, or maybe you are.
This is the backdrop.
Okay, clearly. So the LMI for June comes out. You kind of had to expedite this one because July 4th was right
Yeah.
there waiting on you.
We did, and it was, we come out the first Tuesday of every month, and July is my least favorite kind of month, where the first is Tuesday.
Oh man,
So
and
you got ready.
you had to dodge so much with this summer break you had going on, so
That's true. I was well rested. I was ready for it.
Well, let's hear about it, man. Let's hear about what this month's LMI says, and then of course I want to get into kind of the second half expectation stuff because I think that's what's on a lot. I mean, I get asked about it constantly. What's the second half going to be like? And I wish I had clear crystal ball answers for some of this trade policy stuff, but I don't know that anybody does. But let's see what the data says. Tell us about that LMI for the month of June. Anything stick out to you?
Absolutely. Yeah. So one of the things I think that the data is telling us about the rest of the year is almost a bifurcation of peak season, where sort of upstream import peak season, that's happening now. And then the sort of downstream peak season will come later, as it normally does. But because it's bifurcated, I don't think it's going to feel like a peak on either side. And let me get to the data about why I think that, and then we can talk about what that means. So overall, the index came in a little higher in June than it was in May. And just to remind everybody, any number above 50 is expansion. Further above 50, the faster rate of expansion. Below 50 is contraction. Further below 50, faster rate of contraction. So overall, we came in at 60.7, which is right in line with what we would expect, actually. The all-time average for the index is 61.6, so we're like not even a point off from the average. Where the differences is when we kind of dig into why we ended up at 60.7. So one of the things is, as you showed a minute ago, inventory levels are up right now. So inventory levels came in at 59.8 in June. They were only at 51.5 in May. May was sort of when we had that air pocket that people had been worried about. Yeah, you can see the sort of dip. We look like the TEUs coming through the ports almost. We had a dip in May. And then as we relaxed the tariffs, pushed them back, we saw a lot come in June, and we are seeing it still actually through the first half of July. Now what's, 59.8, that's not a huge number. What is a big number though are the associated costs. So the costs of inventories right now are 80.9. 80.9. Last month they were 78.4. But I think one of the things that's instructive is to look at, okay, well, what were they a year ago? A year ago in June, they were 63.6. Okay, so we are 17 points higher in June of 2024, or in June of 2025 than we were in June of 2024. And those two numbers are 20 points apart. And anytime you start to get a big delta between costs and the expansion rate of inventory, it generally means that we have a lot of static inventory in the system. Now, some of that cost could be associated with tariffs because, yes, we've relaxed tariffs, but it's still 30%, 40%, depending on what we're importing. But more of the increased cost, I believe, comes from the fact that we have so much inventory sitting in the system already. You guys showed, I think, very, very astutely that graph of the big pull forward that we had at the beginning of the year. And then we've had sort of another peak season in some ways in like May, June, and July. And we pulled all this stuff forward. And one of the, that delta, that's big, right? The delta between, it's 20 points overall, the overall index. And it's only, by the way, been above 20 points a couple of times. And one of them, we had a long run where it was above 20 points, was basically most of late 21 into 22 when we had really high inventory costs because we had brought so much stuff in and then everything sort of stopped. So we're in a similar position in some ways. But where you can really see the difference is when we split our responses by upstream and downstream. Okay, so upstream, and this is what I mean by there's two peak seasons happening and bifurcated. Upstream, which is all of our respondents that are not retailers, they had a lot of inventory that has come in, those big spikes we saw in June and now the first week of July. Those have not matriculated downstream to the retail level. And in fact, a lot of the inventory that came in even earlier in the year didn't move to the retailers yet because, Target and Walmart are big and they don't have to carry inventory if they don't want to. So a lot of this stuff is sitting up there. And if you look at our upstream inventory levels for June, it went up at 66.4. Now, inventory costs were still high at 78.7, but that's about a 12-point difference. That's not huge. What is huge is if you look downstream. Downstream, inventory levels were at 44.2. So actually, retailers saw inventories contract in June. This is what retailers always do in the summer. They try to run inventories down ahead of the peak season. And essentially right now, retailers are trying to run those inventories down because they did get so high in the first few months of the year. Now, what's interesting though, the inventory cost for retailers are at 84.
Wow.
Okay. 44, 84. There's a 40-point gap for retailers in their inventory levels, which are contracting, and their inventory levels, which are growing at an astronomical rate. And essentially that is a reflection of some tariff cost, but also the fact that there's still so much inventory left over that we're not moving in a normal kind of a way. And tying all that back, warehousing contracted both upstream and downstream, 49 upstream, 44 downstream, 47 overall for warehousing capacity. Warehousing capacity hadn't contracted since I think like October of 2022 or something. And so we are getting some tightness now in the warehousing market because of this huge bubble of inventory that's currently working its way down. Now, it's not making its way all the way down. I don't expect that it will until August, late August, September, first half of October. Usually what we see is that retail inventories peak on like October 15th, like right in the middle of October. That's when retail inventories peak. I think that will still be the case this year. The difference between this year and a normal year is that everything came in earlier than it normally would to get around the tariffs. And so we have this big, just massive inventory sitting kind of in the middle of supply chains. And that's what I mean by that peak season kind of already has happened. And then once we get to the end of Q3, that's when we will see the second half of peak season. But it's kind of bifurcated. So things have come into the middle of supply chains, but they won't move down to retailers probably for at least another month and a half.
That kind of explains the summer doldrums that we see. So we saw this uptick in, and I like outbound tender rejection rates is kind of a great upstream indicator.
Yeah.
Large nationwide truckload carriers are exposed to that space. DC to DC transfers, DC to store outbound is kind of that second part.
Mm-hmm.
I wonder if you're thinking about, looking at that second half of the year from a demand side. Does it look like that big bump that was the stockpiling before the tariffs, is that going to matriculate into a big bump as it moves from upstream to downstream, or is it kind of in line with seasonal expectations? We just kind of accordioned it all together at once. Will there be enough to spread around for some of these folks who are trying to haul it to those downstream locations?
So there will be, I think, a big movement, right? This wouldn't have come in unless we are going to move it downstream. Now, one thing that can maybe depress rates a little bit is, like we said, there's two peak seasons. I think we should name this episode, by the way, A Tale of Two Peak Seasons. Just it's a
Twin Peaks.
Twin Peaks.
Twin Peaks. There you go. Yeah. So what's one of the things that happens is normally when peak season is closer together, there's more volume for everybody because we have the sort of upstream volume and the downstream volume. But instead, since we're doing it sort of episodically, you may have, it's still the same maybe amount of aggregate volume, but it's because it's happening at different times. It's unlikely to overwhelm capacity in a way that would really drive prices up. Now, I think we'll still see higher prices into big metro areas where the consumers are and everything. I mean, I checked the calendar right before I got on. We're still having Christmas on December 25th. So, I mean, I think there will still be some movement, but I don't think it's going to be like a shipping, a freight bonanza by any means, because we've kind of already done the first half of this ahead of time. One number I think that really speaks to it is if you look at the average inventory being held upstream over the last 12 months. So, 2024 was really a year of kind of JIT, and you can see that if you look at upstream inventory level movements from July of 2023 to June of 2024, it averaged 49.7, which is basically no movement. It's break even, very JIT. If you look at July of 24 to June of 25, so the last 12 months, that number goes up to 58.9. And so we have like this 9-point jump. And what it shows is just all this inventory has been stuck up here. Now, it'll be interesting to see how much comes down, and when it does come down, what happens to it. Because another piece of this, guys, is that so far consumers have been very isolated from the additional cost of the tariffs, which totally speaks to the resilience of supply chains and how quickly the machine turned on and we pulled everything forward when it looked like, okay, I guess we're gonna have tariffs now. And so a lot of the things that have been sold, that consumers have been buying are sort of the stuff that was brought in pre-tariff. The stuff that will be sold in Q4 is post-tariff. Now, again, not the crazy 155% on China that we had for a couple weeks. Another word for 155%? Embargo. That's so if it's at 30 or 40, there will still be some costs that go down to the consumers, right? I mean, we see Prime Day is going on right now, and it hasn't been as robust as it has in the past. And maybe there's some consumer trepidation, and it'll be interesting to see, because I do think everything is going to come down to the retailers. But if they start to get signs that the consumer's not going to be that hot because of cost fears or whatever, we could even see that second piece be a little softer than we normally would. So it's why I'm actually watching things like Prime Day, back to school, because a lot of times those are the canaries in the coal mine for the Q4 season.
Yeah, I think one of the interesting things that I've learned in all of this is like the way that we measure inflation is a little incomplete in the way that, it's measuring things, especially the Fed is looking at the PCE, which is a good measure when consumption is relatively consistent and stable across the board. It kind of shows you the changing preferences over time. However, if a consumer no longer buys the thing because it's too expensive, it doesn't necessarily get reflected into the inflation as cleanly as one would expect. And I think that's something that we're starting to see a little bit of the front edge of, and the numbers. We've got some demand destruction going on, whether it may not be necessarily pure tariff increases that are causing it, but the nervousness within the space that everyone has about moving forward. Now, whether that's real or not, that's another story, but I think we're seeing a lot of, shaky demand characteristics. So on that note, though, because we like to talk about demand because we have a lot of data on it, I want to talk about the supply side of the equation. I mentioned earlier about the maritime market that our Stuart Churls wrote about, and that market seems to be extremely moving independently. Supply and demand seem to not have a pure connection, or not as clean of a connection, because rates are coming down as demand went up, and it's because capacity itself is kind of able to take that on. The truckload market, it looks like, we got tender rejection rates inching higher over the last couple of years, but the market is still relatively recessed for the most part. But we're seeing kind of a transition. Even as demand is coming down, it still looks like it's tightening slowly. So let's talk about the transportation metrics here in terms of capacity and prices, because we talked about this almost this time last year, where it looked like capacity and price, they were inverted once again. This is it. This is the flip. And now we're kind of in this horizontal space where, again, for the second month in a row, we've got this little mini gap between the two. But the forward-looking expectations haven't changed that much, have they?
They have not. No. So yeah, you're right. Last year, I think it was May, we saw the inversion finally happen, a positive inversion where prices for transportation were growing faster than capacity, which it had been flipped negatively for 2 years basically before that. And we thought, okay, here we go. And if you look, those slopes where prices are going up and capacity is going down really hold until about January of this year, and then we see, like you say, some moderation. So let's go back to the beginning, though, which you said, and we'll work our way forward. So one of the reasons, and I've been reading Stuart's articles, And one of the reasons I think we see that dip, here we go, the inversion. One of the reasons we see that dip in container rates, I believe, is a couple things. One, we're not sending many blank sailings back. Like we have so much extra container capacity. If you look at the port of LA right now, I think there's 26,000 empty containers that have been there for more than 2 weeks. They're not going back. They're not going back to, which isn't great. They're not going back to Asia. And if you look at TEUs year over year, the Port of LA always puts out a report every day showing, okay, what's our sort of estimated containers coming in. And if you look at all of last month, we were up like 50% year over year because of the huge burst that came in June. That looks to be continuing through the first few weeks of July. It's up 11% this week, and next week it's supposed to be up 18%. But then the week after that, July 20th, down 14. Okay, so we go from being up 18 to down 14. Okay, so we have a 32-point swing from sort of mid-July to the end of July. And again, this gets back to the Twin Peaks, the 2 peak seasons. Basically, imports seem like they're really slowing down by the time we get to July and August. And so that's one of the reasons why you see container rates dropping, because we've sort of pulled everything over that we're going to need, or at least most of it. And I thought it was nice of the administration to realize that we weren't going to have our homework totally finished on time and extend the tariffs for another 3 weeks so that we had time to play everything in. So now everything gets here. And like we said, they're moving into the middle mile, places like Inland Empire, Phoenix, Dallas, Vegas, and then on the East Coast, of course, like Savannah, everywhere. And what's happened right now is, yes, we thought a year ago that we were going to see, okay, here comes peak season. And it didn't quite pan out. And the reason is because we've had some sort of depressed demand. And so right now we're sort of in this holding pattern where we're at, whatever it is, we're sort of in the 50s. I think we're at 52.4 for capacity, and we are at 62 for prices. So a 10-point split. When you really see the bull market start running is when you get probably 20-point split is when you really start to see things move. And when capacity drops below 50. Capacity for transportation has not dropped below 50 since March of 2022. Okay.
Wow.
So we have had just flex capacity in the system. It has not, and unless capacity starts to contract, you're not going to see prices come up the way that people want them to. Now, looking forward, and I know I only got a minute here, our future predictions do say capacity 12 months from now will be at 45.7, prices at 73. So we actually have pretty bullish predictions from our respondents. Now, that also comes along with the 82 in inventory levels and a 62 in or 62 in inventory levels, 82 in inventory costs. And so essentially what that tells me is our respondents are thinking, look, whatever the tariffs are going to be, they will be there. But hopefully there will be some certainty, because when we have certainty, then we don't have this Twin Peaks situation and we can fully utilize all of our freight capacity. Might be really expensive, but we can at least fully utilize it. And that's something that really can only happen if we have certainty. The tariffs are not necessarily the killer. They're not great, but they're not the killer. The killer is the uncertainty.
Right.
And what our respondents are telling us is they're hopeful that the uncertainty will be gone 12 months from now.
Yeah, and of course that will potentially open the floodgates for them to actually make some plans and move forward. We did have the OBBBA, or that
big beautiful.
that does have some stimulating effects in there, and we certainly don't have time to digest and dissect all of that. But Dr. Z,
so bad. You did Congress before they voted on it, so I don't think anybody read that.
Well, you can go back to your beach time. Thanks for taking a breather and joining us for our little economic freight podcast. And you know what, man? I think you're taking the right approach. Summer, just take it off. I think I would take it off too. See what happens in August. When do classes start?
The 19th is my first class.
Oh man, you got plenty of beach time left in you, dude. Sunscreen, man.
Hydrated. It's hot out there.
All right. And thanks everybody for tuning in this week. hopefully you get to have some beach time as well.
Metaphorically, my brain's on the beach, but the supply chain, it will continue to be a hot, uncertain summer.